Call to order the Oklahoma City Post-Employment Benefits Trust for Monday, February 11th, 2019. Thank goodness for no bad weather, and all of us are here. First thing is to approve the minutes of the meeting for December 6th, 2018. All in favor? Aye. Any opposed? Our next item is to a presentation of the investment performance review for the period ending December 31st, 2018. Doug Anderson, starring in our center performing role.
It's all right. I'm okay. Thank you. Good morning, everyone. Start with the bad news first, with the December 31 report. There's also a January 31st update, which thankfully saw the markets come back with some enthusiasm from the weakness at the end of the year. If you would open up the larger December 31st book up to page 1, it is a letter from our CEO, President and CEO Mike Welker, about the state of the firm. I've been involved here for quite some time under two different firms as our firm merged with A&Co in 2015. Some highlights about our firm today are we have 89 employees. When you first hired us on at the previous firm, we were less than 10. We have $90 billion in client assets that we oversee. So this is a very large organization. We're completely independent. We are owned by ourselves, employees, and we have zero conflicts of interest because we're paid only by our clients. We don't get any funds from any brokers, investment managers. Nobody else out there pays us except for our clients, and that helps us keep our interests aligned with one another. So all we care about is making our clients happy. That's it, and that's the best way to build a firm. So our firm has grown over the past year. We've actually bought part of Summit Strategies, which is a St. Louis-based firm that does a lot of public fund business, both on the coasts and also in Missouri itself, and that was part of a competitive bidding process where we beat out the other major independent firms to get that business. So it continues to be a very, very strong firm, committed to our long-term principles, which are independence, disrupting the industry in a positive and productive way. So if we look on the next few pages, the firm update is over. Talk about market environment. Market environment was very difficult, and it turned very negative very quickly in the fourth quarter of last year. It appears that the markets bottomed out in between Christmas Eve session closing and the day after Christmas, the market opening back up again. Because if you look at that day, it was sort of when the market was down 700 points on Christmas Eve, on a holiday shortened session on fairly low volume, you could kind of tell that there was something going on out there, that people had sort of given up for the year and said we're going to come back next year. But then the day after Christmas, when the markets opened back up, it was up 1,000 points. And when I was with my colleagues in Florida earlier in the year, in January, we were actually talking about performance since Christmas Day to the day that we all got together, because it was so alarming and so amazing. The economy is strong, right? I think we're going to have 2.7% growth in the fourth quarter of last year is going to be the official reading. We had 3.5% in the summer 2 quarters there. Unemployment is below 4% in the United States. Is there some uncertainty out there? Absolutely there is. China trade, that's a huge issue right now. What's going to happen if the government shuts down again? I think, we made it through last time. We'll probably make it through this time as well. But I think the China trade is the biggest issue. And then also what the Federal Reserve will do. Because it appears the Federal Reserve has hiked interest rates many, many times over the last 2 years, but it looks like they may be pausing right now. Some of the economic numbers don't see inflation as a danger. And I was trying to talk to Bob about this. One of the biggest inputs to inflation in the United States, energy prices. It's traditionally been oil, natural gas, et cetera, coal prices have all been that sort of the initial push of inflation. When those prices start going up, then inflation follows, and the Federal Reserve has to act to raise interest rates. Weather is not nice outside today. The weather is much worse if you go north of here. If you look at the polar vortex and think that was a significant event, you had observed low temperatures in Minneapolis and Chicago, the lowest they'd ever seen. And if you look at natural gas prices, which is a major component of heating in the winter in the United States, they didn't move a bit during the polar vortex. And I remember 10 years ago, we would have seen something like that before the energy revolution, renaissance of the United States, that we would have seen natural gas prices up 15, 20, 30% at just the forecast of a major winter storm coming through the United States. But because we are now the largest producer of oil in the world, we are the largest producer of, one of the largest producers of natural gas and the largest exporter of natural gas. You go to the Permian Basin just south of here, and natural gas that they're bringing to the surface is actually a cost to the oil drillers down there because they have to put it somewhere. So when you see that oil or natural gas prices don't move, oil prices don't move, with a major winter storm out there, it's really hard to see inflation coming from that part of the world anytime soon. So economy is strong. Markets were shaken pretty badly in the fourth quarter. There was a lot of stuff going on, and it seems like the impetus of that was potential government shutdown, China trade issues, and then also the Federal Reserve sort of being too aggressive in slowing down the economy. And it seems like one of those has been addressed. One of them is ongoing with the China talks starting again today, and then the Federal Reserve may be on hold for a little while right now. So what I always like to say is I'm never going to be as depressed as the market is. I'm never going to be as enthusiastic as the market is, because reality is somewhere in between there, and that's why we have a disciplined investment policy. But looking over on page 2, the market environment here, you can see that negative results for the quarter except for fixed income. That's on page 2 on the upper right-hand side. International equities were down slightly less than the U.S. because they had been on a downward path longer. We saw the sort of crescendo selling that hit the small cap market especially hard, down 20%. As of Christmas Eve, I think that at the low point on the day, markets were down peak to trough about 20.001%. They closed up a little bit. So we did, in fact, have a bear market for a few minutes in the large cap set of the large cap part of the marketplace. Small cap's down quite a bit worse. Looking down at the one-year performance summary, you can see there the red columns, the pink and red column. Those are international equities down double digits. You can see U.S. equities were down far less than that. And you see on the bottom there that the best place to be invested last year was cash. That is the first time that has happened since we have been investing this portfolio. So if you want to de-risk the portfolio completely and move to something like all cash all the time, you'll be right one every 20 years, probably. You can pat yourself on the back for that one. The next page shows the U.S. equity market performance by sector, by style. The top one is equities by large, mid, and small, by growth, core, and value for the quarter, and below is for the year. And you'll see there's a reversal during the year where the blue columns are value stocks amongst each of these market categories. The red is the growth stocks, and you can see that value stocks during a down market outperformed, right? That's generally what happens. You'll look down for the one-year performance, and you will see that the growth stocks actually held in better for the entire one-year period of time, but that's because we had 3 good quarters, or 3 positive quarters for the most part, and then one very poor one. Looking on page 4, you'll see the sectors of the marketplace, and energy was really poor. Energy was the worst performing segment of the market, just absolutely unloved by investors. No matter how high the yields are, folks do not want to be investing in energy companies for some reason, even though their earnings are strong, they're priced very attractively right now. It's just not the place where folks want to be investing. If we look down to the Russell 2000, you can see negative performance everywhere there except for utilities. Again, the most defensive areas of the market are the only place that had a positive return. I read a story as one of those lists that you see on the internet. It's like, you know you were an investor in 2018 if, and one of those was almost nothing in your portfolio worked by the time you got to the end of the year. So looking at the following few pages, you'll see the international similarly poor returns, although emerging markets did well during the fourth quarter on a relative basis. And you look on page 8, you'll see performance of the various parts of the bond market. And as we're looking at that there, AAA had a positive return. High yield was down. That's got an equity market linkage to it. But as you look down to the bottom, you can see that for the 1 year, the aggregate was barely positive. And again, that's very, very unusual because as asset allocators, as we are, we have our two main areas to invest are equities and fixed income. We would have everything in equities because that's the long-term driver of positive returns above inflation. But we need to have some in fixed income because it is a hedge to equity market volatility in almost all cases. So this year, where you saw equities down and you saw bonds down, is a highly, highly unusual situation, and it bit all investors out there. On page 9, you'll see fixed income market data here. On the right-hand side, at the upper part there, you can see these are yields, market yields for U.S. Economy, and you'll see that it's a mixed picture. If you look at the green line, which is the 10-year Treasury, and you look at the light blue line there, which is the BAA option-adjusted spread, you'll see those are moving in different directions, right? Interest rates tend to move fairly similar channel to one another. And another interesting thing is you see that set of green boxes that look like a set of stairs going up and to the right. That's the Fed funds rate. And the reason it's in a box and not a line like the others is that the Federal Reserve is now targeting the Fed funds rate in a 25 basis point channel. So when they cut interest rates after the great financial crisis to 0, they said it is 0, but it's in a range from 0 to 25 basis points. So every time they hike rates now, they go from 0 to 25, and they go from 25 to 50. And that's the channel that they're going to keep it in, and then it's going to be 50 to 75. And that's why it looks odd there. But it appears that after that December 18 interest rate hike that we may have a pause in interest rates because it sparked such a fury in the markets at the time. Too much, too fast. Looking at the next page, we have a loss for the year, negative 5.2%. So it was a tough time. We were able to allocate into some of that weakness, and more on that in just a few moments. Page 12, you will see, unfortunately, there's a decline in market value, few and far between on this list, as you see that how strong the growth has been. We go back to 2009, the shadow of the great financial crisis, $5.3 million, and today we have 52.4, or as of December 31st, and as of January 31st, even more than that. So the assets continue to grow. I'll spoil it a little bit. January is a great month for the markets. Everything that did poorly in the fourth quarter has done very well in the first quarter. In fact, the parts of the portfolio that did the worst in the fourth quarter are the ones that have rebounded the fastest so far. We're looking at the allocation on page 14. There were some changes here. You will notice the domestic equity declined from 65% down to 58.9%, and most of that was due to market depreciation. We'll get into that on the next page. You will see that core fixed income rose dramatically. In fact, some of those market values were noticeable changes. So core fixed income went from 8.6 million to 9.6 million during the quarter, and that helped stabilize returns somewhat. You look at active duration fixed income, that went from $4 million up to 5.25, we'll call it, $1 million during the quarter. So again, the stabilizing assets did their job and they stabilized somewhat. And then on page 15, you can see the breakdown of managers by individual portfolios here. The largest is Vanguard. We have long had the debate here about active versus passive. I'm not convinced that active is a reliable place to add value on the large cap side, so passive is absolutely acceptable there for me. We're getting market returns and we're paying very, very little for that. I think it's important to recognize that Jack Bogle died earlier this year already, the founder of Vanguard, true revolutionary within the industry, went into a business trying to simplify, make it transparent and low cost to investors, and he founded Vanguard. He did not think that index funds would ever amount to be very much of the marketplace right now, but apparently 17% of the U.S. equity markets are controlled by index funds today, which is significant. We go down the list, you'll see we have our active managers, we have our active duration, international equity. What this list and what this chart should tell you is that we are very diversified. Going down onto the next page, you can see that this is the financial reconciliation, so this is where we were, where we are, and how we got there page, and you can see at the beginning of the quarter, 10/1, or October 1st, market value is $55.3 million. Contribution of $4 million happened during the quarter, and where those assets were allocated, we put $953,000 of those assets in domestic equity, and we put $2.2 million of that into fixed income. So that was very helpful during the quarter, but we were going to long-term targets. You'll see that the appreciation, depreciation, on the far right-hand side, the pain column here, during the quarter, it was very, very difficult. Now, remember, this depreciation came mostly from the equity side, and those are painful results, right? There's no way about that. That is painful to look at that. And just remembering that how quickly or how close to the end of the year those results happened can remind us that markets can move very quickly in one direction. They can move very quickly in the other direction.
Doug, I have a question.
Yes.
Of the $53 million that we have, what percentage of that is market gain?
Is market gain?
Versus contributions?
That is a great question. I don't think I have those figures, but I can have our folks find that out.
That would be great. Thank you.
That's a great question. If you look at this, you can see where we allocated. Right now, we're in the process of allocating another $1 million right now that's going into the trust to be invested long term, and those are tending to be over on the equity side right now. So again, we try to allocate to weakness in the marketplace, but we have a long-term asset allocation target, and that is something that we talk about significantly here. That is going to be the biggest determination of long-term rates of return, is how much you have in equity versus fixed income. A few years ago, we bumped up our allocation to equity, and it's been very helpful over the last 3 years, although painful over the last 3 months of 2018. And looking down this list, again, for the fourth quarter, there was only one asset that had a nice return during the quarter, and that was the Hoisington long-term treasury active duration fund. So it's invested only in treasuries, and its main job is to ballast out the portfolio when equity markets are difficult. So it did its job. Looking over the page 17, and again, a lot of this is old news because January results were very strong. We continue to push higher today. So the one-year rate of return, negative 5.2. We looked down the list. Where did those losses come from? Limit sales was down 2.7%. They had one of their very poor years that they tend to have, 1 out of every 10 or so. You look over their last 3 years, that includes up to 12/31, their first percentile. Double Line is a sort of more cautious fixed income manager, and they had a gain for the year, and they were up 3% for the last 3 years. And it's interesting, we have 2 core bond managers here. We've done a great job selecting those managers. We have one in the first percentile and one in the third percentile over the last 3 years, first being the highest amongst that group, 100th being the poorest. We look at Lord Abbett, the high-yield bond portfolio, and yes, it was down for the quarter and the 1 year. It has rebounded nicely so far in January, and over the last 3 years, it's 22nd percentile. Hoisington, you don't like, it's difficult to like them because when you see them putting up their best results is when the rest of the portfolio is usually doing the poorest. But that's why they're there. You see during the quarter, they were up 4%, and that's a 10% allocation of the portfolio. So that's meaningful when you look at that. Without that portfolio, we would have been down more than 5.5%. Or I'm sorry, we've been down another 40 basis points, so we've been a loss of more than 12% during the quarter. So they definitely did their job there. On the one-year column here, you look at Vanguard. The index funds track their markets very closely and actually ended up a nice peer ranking. Hotchkiss had an awful quarter. They have an energy exposure in their portfolio, which sold off very, very treacherous. It was a bad quarter for them, but you look at them for the month of January, they were up 17%. So again, what went down the most in the fourth quarter went up the most during month of January. And Stevens, this is interesting. We've kind of had Stevens in the ins and outs here. We've been happy with them. We've been not quite so happy with them over periods of time. But when I look at the last 1 year rate of return, their index was down almost 9%, and they were up 3%. That is a fantastic rate of return, especially when the market's down over 9% and you're up 3%. I mean, anytime I see a 12% outperformance, I'm very happy with that. But when we have a gain, but the market was down over that period of time, that's even more incredible. And then our international equity portfolio, which is part of our long-term diversification strategy. International equity was very tough last year. No two ways about that. Europe, with the Brexit, China talks, everything out there in the international world was very difficult. I like to look at page 18 for just a moment here. Rather than having, these are calendar year periods that show us our rates of return. You can see for the 2017, the total fund was up 16.7%. 2016, it was up 8.4%. And then 2015, that was a really tough year for us here. It was down 2.67%. And the year 2014 sort of led into that at 2.4%. The trend here at the total fund level is very positive. Right? We look at the 3-year annualized rate of return, 6.25%. It is below our actuarial assumption, but it's the 18th percentile rank. So the last 3 years have been very good. The fourth quarter of this year was very difficult, but it appears that that was temporary and very short-lived market sell-off. As I look at earnings on the corporate market today, they're coming in just as strong as they did last year. The economy is strong, and we have good exposure, both passively and actively there. International equity was tough last year, very, very difficult. So when we look down this list, you can see quite a few of the numbers are very strong on page 18 when you look at the year by year. And if we look at history, a manager who's in the top quartile of their peer universe for a 1 year period of time, or for a 3 year period of time, if you look back over those individual 3 year blocks of returns, they're going to be in the below median or the fourth quartile, probably 1 out of those 3 years. So it's not unusual to see ups and downs like this, but it's a matter of knowing how to take advantage of that and having long-term discipline to do that. So the individual managers are shown on the following pages. I don't think it's, I'm happy to answer any questions about them. If we look at the individual managers, remember Wasatch has 5 holdings, I believe, in their portfolio. They're all very long-term treasury bonds, 30-year treasuries. And then you look at somebody like Lord Abbott, who'll have a couple of 100 bonds in their portfolio, and the same is going to be true for Loomis Sayles or Double Line. Our equity managers, again, targeted, long-term, cautious investors out there. Sometimes they can be stubborn, which hurts in the short term, but really they're trying to buy, in the most case, assets with unappreciated value, and that means you have to go against the market for sometimes. Excuse me. Page 35, interesting. Correlation matrix. This shows us diversification in numbers, measurable diversification. So correlation matrix tells us how our assets perform versus each other. This is for the 5 years ended December 31st. If you have perfect correlation, that means moves in lockstep, 2 assets move in lockstep with each other. That's a correlation of 1. You'll notice that diagonal set of boxes is 1. That's because you're comparing each fund to itself. But as we look down through that list, and especially when we're looking at Wasatch D, that's row and column D, you can see a lot of negatives there. That means that it is actually diversifying. It is moving the opposite direction as our equity portfolios, and that's why I'm comfortable having a 10% allocation there. We look at page 36. Causeway, I think they should remain on alert, but I see no reason either qualitatively or quantitatively to change the status of any of the others. And on page 37 is our fee summary here. So when we look at the expense ratio of the funds we're invested in, 48 basis points, category average, weighted average. You can see the individuals on the lines there, but when we do the same weighting scheme as the category average, it would be 80 basis points, so a 33 basis point difference. And as large as the portfolio has grown, that's now $120,000 savings per year. We don't think there's any sacrifice of quality. In fact, one of the most attractive things about some of these funds is they charge less than the marketplace, which puts you a step ahead when it comes to the competition out there. And on page 38, you see the asset allocation here. Because of the significant new dollars that we put into the portfolio, on page 38, you can see all of the funds are very close to target. What those bars show us are the maximum and the minimum of each category. You notice for the bonds, we have a very wide margin. We can cut risk on this portfolio significantly if we decide to, and we did in the past. I'm not suggesting that as something we want to do, but we do have the freedom to do that. And you'll notice here that almost all of the categories are very close to their target. If we look a quarter ago, all the equities were overweight, right? Meaning that the equities had appreciated more than the bonds. And so when it came time to allocate this additional $4 million, we didn't give much to equities. Most of it went to fixed income, and that timing worked for us this quarter. If we would have allocated more to equity, if we would have gotten outside of our policy, our losses would have been more severe than they were. So it is a disciplined. We take the choice out of it. If we looked at the third quarter, where do we want to put assets? Probably would have said, well, equities, of course. You know, they're up strong this year. Why would we put it in fixed income? But the policy says we need to go to fixed income because that's our long-term plan, and we did, and it helped us out during the quarter. So that's all I have for the 12/31. Got the bad news out of the way in a hurry, hopefully. But again, markets are cyclical.
Doug, I got a question real quick. I think last meeting you mentioned Fidelity's zero interest funds, particularly the S&P. Is that something we could avail ourselves of, and is that something we should look at?
The answer is no, we cannot. Those are for individual investors only. And what Ted's referring to is index funds are super price competitive right now. In fact, Vanguard has long been the leader in having the lowest cost index funds because they are not a for-profit company like Fidelity's, like Schwab's, like those others are mutually owned. It's like a mutually owned insurance company. So as a shareholder, you own part of the company, and so hence there's no reason for them to build in huge profits into it. And that's how Vanguard has evolved, and they're totally different than the other fund managers out there. Fidelity, Schwab, BlackRock, et cetera, have seen how much money is flowing to the index funds, and they're very competitive there. Fidelity, which had been an active manager only for a long time, decided they were going to go into the marketplace, and their first salvo against Vanguard is that we're going to take whatever Vanguard would charge you and do it for 1 basis point less. And if you're paying 50 basis points, that's not a lot. But if you're paying 4 basis points and Fidelity will charge you 3, well, that's 25% off. That's assuming they can hit the market, they can match the benchmark as close as Vanguard can, and that has yet to be proven. But the second salvo that Fidelity launched against Vanguard was we're going to have index funds which are free to you, right? Which they are getting paid on them. It's just not being paid by the folks who own the fund. It's through this thing called securities lending, which is I would say it's not 100% clear and transparent that they're being paid on it. But they said if you open a new account at Fidelity and you're an individual, we'll give you 0%. But as far as institutional investors like us, no, we're not available. But there are some interesting things happening. Vanguard continues to push prices down. They continue to rationalize the share classes, right? So there are share classes that, you know, the smaller amount of assets you have, the higher fee you pay. But you're talking about starting at 4 and moving down from there. Shockingly, for the S&P 500 index fund, they have a class of shares. It's the lowest cost that you can pay for them. Minimum allocation to qualify for that is $50 billion. I know, it's the same look. Every time I say that, it's the same look. A share class with a minimum buy-in of $50 billion. It's just astonishing. And again, just one more tangent on that. We have to be the standard that we're held to, the fiduciary standard, is reasonableness. We don't have to have the cheapest. I think it is entirely reasonable to keep the assets at Vanguard because of the strength of the organization, because of the reliability of the returns, even if we have to pay 1 basis point more. In fact, the transition from Vanguard to somebody else might end up costing you 10 times the savings that you would pick up over the next year if you mistimed the market. So I think it's very, very reasonable. I don't think anybody, this is personal opinion, I'm not a lawyer, I don't think you're in any legal jeopardy or fiduciary liability for having Vanguard index funds. As long as you're in the lowest share class that you can afford by your asset size, and that's something we keep a close eye on.
If there are no other questions on the December 31st report, our next item is to receive the monthly investment flash report as of November 30th, 2018, December 31st, 2018, and January 31st, 2019. And unless the other board members would have any objection, I would suggest that since we just heard an in-depth presentation of our December 31st report, perhaps we just skip to the good news of the January 31st report. Okay, let's go.
Very well. January 31st, you can see as you open up the market update there, the returns were positive, a slight dip. But you look at the returns for the quarter, the Russell 1000, that's large cap U.S. stocks, up 8.38%. Russell 2000 small caps up 11.25%. International is up 7.56%. These would be good one-year returns that we saw during the month of January for the entire year. Please don't extrapolate that over 12 months' time. It's not possible. It's not going to happen that way. But again, it does show us that when markets do turn volatile, when they get into sort of, I won't say not quite as far as a panic phase, but as far as a highly a hyper-vigilant term, when everything is negative news, then generally when that sentiment changes, it can turn very, very quickly, which we saw in January. Looking at the sector performance just below that, you will see the strength of the returns, and energy was the top performer across the board for the month of January. Energy companies' earnings are strong. Of course, the activity in the oil patch is strong and getting stronger every day, it seems, especially for United States investors. And as we go down the list, another one that stood out as very, very strange to me was real estate, up double digits during the month. These are diversified portfolios, and I guarantee you that the underlying value of the properties within these funds did not increase by that much over that 1 month period of time. It was just, market was oversold in December, and the interest came back in January, and folks wanted safe returns. That comes from places that have high yields. So when we look over on the next page there, the asset allocation and performance, this is the good news here. You can see that over the 1 month period of time, 6.98% rate of return, and these are, you can see that return versus the policy index and the actuarial assumption for the last 3 months. We're up almost 1%. For the last 1 year, we are down still, down 1.83%. But the last 3 years really is indicative of the changes that we made most recently to the portfolio, increasing our long-term allocation to equity, changing up some of our managers. We compounded 10.33% per year over the last 3 years. That's a good rate of return. We should be happy with that. And looking down that list, for the quarter, Loomis sales, remember they had a very difficult first month of 2019. They're up 3.42, double line, positive return. Lord Abbott, positive, very nice return, 4.85%. Our best returner during December was Hoisington. They're up 4.8%. You can see they're up, but modestly. Over the last quarter, they're up 9.52%. So again, that gives us some courage to keep investing with them and hang in there until equity markets do get a little sideways, and that's what their job is to do. Looking at our index funds, Vanguard hitting the benchmark across the board, 8% for the month. For the S&P 500, the mid-cap is up 10.55%. And our poorest performer during the month, or the quarter of fourth quarter last year, is now the top performer, 17.14%. Russell mid-cap index is up 10.79. So active management can help. Looking at Stevens over the last you look at them for the month and the quarter, they are down slightly, but that last year, same pattern, they're positive while the index is negative. And then we even saw some life in the international equity portfolio at 7.2%. Yeah, I believe they are. It does not, I was looking for that footnote, but these are all mutual funds, so yes, they are net of fees. That needs to be footnoted here, but to the, this production cycle is pretty quick. I know it's, was it the 12th or the 11th? So yeah, this production cycle is quick. 95% sure that these are net because they are funds. We would take an extra step to add those back in. I don't think we do that. So I'll get the footnote on that next time. And I'm happy to take any questions.
Hearing no questions from the trustees, I would point out that the other two reports are also included in your packet, so I would entertain a motion to receive all 3 months' flash reports. All in favor?
Aye.
Any opposed? Our next item is to discuss, consider approval of additional asset allocations or changes to portfolio fund managers as recommended by the board or the investment consultant. I heard you suggest that we leave Causeway remaining on alert, Doug, and if there are any other issues that we should consider in terms of changing the asset allocation. I also heard you say that we're pretty much on target, especially at the end of December, on that, or any other changes. Does the board have anything to submit on that? Hearing nothing, we will move on from that item. The next item is acceptance of the interim financial statements for the 6 months ended December 31st, 2018. Good morning.
I'm Rhonda Dugone. I'm with the Accounting Services Division. Let me put on my glasses.
I wish I had those glasses.
It looks like you have the annual report on your docket first. So starting with, no, you have the interim. I'm sorry, you have the interim first. So
Right,
starting
we should
with
do interim first.
Yeah, starting with the interim, if we could turn to page 6. The statements of changes in planned net position. After the second quarter of the fiscal year 2019, the trust is reporting a net position of $55 million. This is an increase of $2.27 million over the prior year when the net position was $53 million. I'm sorry, that was on page 5. Moving on to page 6, on the statement of changes in planned net position, the trust reports $5 million in depreciation in the fair value of investments at December 31st. And like Doug spoke about, it was due to the uncertainty in the Federal Reserve and interest rate increases. And this depreciation is what attributed to the net position remaining stable as opposed to seeing it growth. Employer contributions and plan member contributions remain stable, although if you look at the table, it appears that they did not. It was just that the prior year there were only 5 months of employer contributions recorded. They were caught up in February, but they remained stable throughout the fiscal year. And if you can turn to page 20. At the top of the page, under net Opebt liability, June 30th, we had an actuarial evaluation of $422 million compared to the prior year of $523 million. And then at the bottom, you can see that the Opebt liability funded amount is 12.10% as compared to 8.5% 0.58% for the prior year. That's all I have for the December.
Are there any questions for Rhonda regarding the interim financial report? Hearing none, I would consider a motion for the acceptance of the interim financial statements for the 6 months ended December 31st, 2018.
Move it.
All in favor?
Aye.
Any opposed? Our next item is the acceptance of the annual financial report for the fiscal year ended June 30th, 2018. Rhonda?
For this one, I'm comparing the preliminary report that was presented earlier and comparing it to the final. Between the two reports, the net position only increased $2,000 from $58,115,000 to $58,118,000, and it was primarily due to an increase in investment income that was reported on page 7 of the statements of planned net position. The only other notable change was from the preliminary financial report was that the actuarial information was received, and it was first initially reported in the September, the first quarter interim. But that is it.
Are there any questions regarding the annual financial report for the fiscal year ended June 30th, 2018? Hearing none, I will entertain a motion to accept the annual financial report.
Move it.
All in favor?
Aye.
Any opposed? Our next item is to ratify the claims listing. Is there any question concerning the claims listing that's included in your packet? Then I will entertain a motion to ratify the claims listing.
Move the item.
All in favor?
Aye.
Any opposed? Our last item is the reports or comments from trustees, staff, and interested parties. I'll go in reverse order. Are there any interested parties to make comments this morning? Hearing none. Staff? Then trustees. Ted? Diana?
No.
No? Neil? Okay. Then we are adjourned. I just wanted to do that. I just wanted to do that.